Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to talk about, it's a really important question, can you rely on the big miners to actually keep on paying good dividends? Paul, what do you reckon?
Well, let's start with what they're actually paying at the moment, Peter, and there are some fabulous dividends potentially on offer.
This is a staggering chart.
Now, I put a bit of caution here. These are forecasts. These are based on the major brokers' forecasts about dividends and the yields, effective yield that is on the three major miners we're going to talk about, BHP, Fortescue and Rio. So let's take Fortescue as the example, current price around $21.43. The market, the major brokers are forecasting a full year dividend this year of $3.52. That puts Fortescue on an astonishing yield of 15.6%, Peter. That's franking on top of that as well. But next year, the following financial year, FY22, they're forecasting the dividend to fall to $2.51.
Still good.
And that would still give Fortescue a yield of 11.1%. But there are some crazy yields there. Now, as I said, caution here, these are broker forecasts. Yeah. They change quickly you know, they're fabulous in terms of being a forecast.
That has to be right.
But caution is required. And the reason that caution is required is that, as we'll come to later, they're really totally based on the iron ore price. BHP is the most diversified of those, but iron ore is the major commodity driving those sort of returns. And let's have a look at the iron ore price over the last 13 years. And you can see we're now back to record levels, over $180 per tonne. It's back in the levels it was in 2011, 2012. That was really the last great mining boom when we talked about the commodity super cycle. But just look at that chart. It was also at that level in 2008. Had a huge dip during the GFC. It went by a factor of 3 times down, a third from in 2008, 2009. And then it fell from $180 in 2012 back below to about $50 in 2015, 2016. Now we're back at 180, so enormous volatility. Sure, driven partly by the growth of China and post the pandemic, but Peter, a lot of this is to do with production issues at Vale in
And the
Brazil.
important point, Paul, is when the iron ore price is rising, dividends can go up, but when they fall, and there's plenty of falls there, those dividends can shrink and even disappear.
Yeah. So let's look at the individual share charts. We'll just take this over a slightly longer term. This is BHP's share price over the last 30 years. We are an all-time high at $50, but look at that. We've had a number of peaks around $40. We've had a peak in about 2011 at $40 or $48, I think it got to. It's fallen all the way back to about $14 in 2016. So it basically dropped by a factor of almost 3 times. Yeah. It's now gone up by a factor of almost 4 times, back up to almost $48. Okay, you can argue the long-term chart is up, but a lot of volatility in that share price. Yeah,
you have to be patient through those really rough times.
Yeah, and BHP of the 3 miners is the most diversified because it's also got big revenue streams in copper, which is doing really well, and oil, which has also started to do well in addition to iron ore. Rio is the second company. This is over the same period, 1992 to 2021. Look, about the same, a little more volatile because it's more dependent on iron ore. You can see it was above $100 in 2008 and went down to almost $20 or about $25 in 2009. We had the same sort of bottoming low in 2016 of just around $40, now up $120. So a lot of volatility. You know, again, a caution for investors. Let's move on to Fortescue, and it's probably even more instructive, the third in the company. This is the most dependent on iron ore because at the moment it's almost 100% iron ore. We've seen a lot of run up. We've seen it really below $5. Even as recently as 2018, 2019, it got into the 4s. Now up at $21, $22. That's a factor of almost 5 times. Huge run up, but I think caution required. Yeah. So let's move on to sort of go back to that question we started with about dividends. Can dividends be relied upon? And I'd argue they can't, Peter, and I think...
not for a long time.
Not for a long time, and there's an old saying about you don't buy miners for dividends. And these are the reasons, and I think as we've demonstrated in the chart so far. First of all, miners are price takers. What that means is they have absolutely no control over the revenue they receive. They have no control over the commodity price. They take whatever prices people are prepared to pay for. They have a limited control over their cost, over their production. They can
They can cut production.
They can cut production. They can increase production marginally. We've seen it takes a long time to increase production.
Yeah.
They have a little bit of control over their cost base, but overall, when you're producing iron ore at $13, $14 US a tonne, which they are, and you're selling it for 180,
yeah.
all the revenue and the profits in that margin, the actual production volume and production costs, they're hard levers to change. So they are totally dependent upon the market for the profit. Management might look really smart, but hell, Peter, they're not really doing a lot. So that's not being uncharitable management. Of course, they're doing a lot, but in terms of the profit outcome, they really have no control about that.
And we know that prices for iron ore are high because there's problems in Brazil for Vale. That could change over time, which could bring prices down.
And we also know that it's very hard to forecast commodity prices. In fact, the major brokers will tell you they're not really good at forecasting. No. And all their dividend estimates are built upon their forecast. But history says that the market is not a good forecaster. So that's the caution. I think a second point to note with miners is they're a little bit unique. It's not like investing in a tech company or investing in a grocery chain or whatever it is. Mines actually run out, right? You actually mine all the ore and it's all gone. Yeah. You actually the oil well goes dry. So they are exhausting resources. And so because of that, miners need to think about the next ore body or well they're going to drill or whatever it is, and they're very capital intensive activities. So what they tend to do is when they're raking the money in, they pay out dividends, but at some stage they have to preserve capital because they know there's going to be a big capital drain when they start the next...
To buy a mine or develop a mine
or whatever it is.
Yeah.
And that's something that's quite unique to miners. So just caution about that. The revenue stream eventually denudes, becomes a lot more expensive to get out of the ground and eventually runs out.
It's another reason why dividends aren't reliable.
Yep. And thirdly, I think this is more slightly a newer phenomenon, is the whole ESG movement. A lot of our miners are involved in so-called carbon-intensive mining activities. The mineral or the ore or the oil is carbon-intensive. Big move in the ESG world, obviously, which is a negative for that. And so a lot of the miners are starting to not just exit some of the things like thermal coal, but they're starting to look at more green-based activities, hydrogen and other types of things. They're going to be pretty capital intensive.
Yeah, cost in the short run potentially might give a long-term return, but there'll be a cost in the short term.
And my final point, Peter, is that history is against this. If you look at, just have to go back to 2015, 2016, the BHP chairman at the time famously talked about the progressive dividend policy, that is they're going to keep increasing their dividend every year. It was abandoned in about 2017, 2018. History is against relying on mining companies and listening to miners saying we can keep paying that dividend. At the end of the day, they've got almost no control over that. So while the miners look fantastic value now and for fantastic dividends, just don't bank on it, all right? Just be wary that you're into something that's pretty volatile.
Miners are generally a growth stock that occasionally gives you really good dividends, but you just don't expect it forever. That's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.